Do you currently have any index funds in your stock portfolio? What if he told you that a big stock market bubble may be being fueled by the well-known market monitoring index fund? Michael Burry, a renowned investor, recently stated exactly that on Twitter. The passive investing bubble that grew consistently over the past 10 years, according to the quote, is what makes the current situation different from the dot-com catastrophe of 2000. Quote, "The difference between now and 2000, also known as the dot-com crash, is the passive investing bubble that inflated steadily over the last decade. All theaters are overcrowded and the only way anyone can get out is by trampling each other, and the door is only so big." But what does he mean by this? And is it possible that the good faith market monitoring index fund will actually collapse the entire stock market? Let's find out then. Hey, welcome to Stock Market Mate. Today we'll talk about Michael Burry's 2023 warning for the index fund bubble. Before we start, hit subscribe button to help us beat the YouTube algorithm. If you're done with that, then let's get right into the video. So just to review, when you purchase a market tracking index fund, you are essentially purchasing a stock that symbolizes market diversification. For instance, SPY, an S&P 500 index fund, is the largest index fund in the entire globe. Hence, if you purchase shares in SPY, you will actually control a relatively small portion of the 5,500 greatest American corporations. The concept is that, by purchasing the market, you will eventually receive a return equal to that of the market, which, according to history, is not too bad. For the S&P 500, it is approximately 10% per year over the long run. And over the past few decades, passive investing has been very popular due to the quite literally astounding historical annual return of this approach, as well as its simplicity and ease of implementation. According to a recent survey by Bloomberg Intelligence, passive instruments held an average of more than 20% of the shares of each business in the S&P 500. Passive structures owned about 3.3% of the market in 2003. These kinds of figures have already begun to raise concerns about whether this predominance of passive investment is indeed beneficial for the market. Michael Burry unquestionably believes that it is cause for alarm. Though he just brought up the passive investment bubble on Twitter, it turns out that this isn't the first time he's brought it up. In fact, back in 2019, he did an email interview with Bloomberg on exactly this topic, where he noted, quote, "Passive investing has removed price discovery from the equity markets. This means that as passive investing gains popularity, more and more shares of these major corporations will be held over time, not because the investor truly likes the company, but rather because it is included in the index. Over time, this will cause stock values to overinflate. The basic performance of these organizations is no longer the only factor influencing share purchases. That is, in fact, being driven by the fact that they just so happen to be in the appropriate index. That is a bubble right there. When an asset's price increases for a factor other than its fundamental performance, you can usually tell. Thus, the question is, could the rise in popularity of passive investing lead to a bubble big enough to endanger the stability of the market? The solution, as always, is unclear if investors begin switching in large numbers from index funds to cash. Consider once more how stock values actually fluctuate. It's fairly easy. Stock prices fluctuate according to supply and demand. Thus, if many investors want to acquire shares but only a few are willing to sell, the stock price will rise. On the other hand, if many investors suddenly wish to sell but there aren't many bidders, the stock price will decline. Now, each stock has a typical daily trading volume, or the average number of shares that are traded each day. And one thing to keep in mind about daily volume is that, unless it is abruptly and significantly disturbed, share prices don't really move that much. Yet occasionally there might be such a torrent of volume seeking to get out that it can quickly destroy the stock price, like in the case of a market crash and widespread selling. Although there won't be many buyers, there will be a large number of sellers. As a result, until other buyers show up to settle the issue, the price will be set by the player who is trying to depart in the most frantic manner. The only way someone can leave a crowded theater without stopping on others, according to Michael Burry, is by pushing and shoving their way out, and the door only opens so far. This alludes to a traditional stock market illustration that clarifies daily trade volume. In the example, there are 100 people in the theater, and the only restriction is that in order to leave, you must locate a replacement for your seat. So that's okay under regular circumstances. Typically, someone will wish to enter and see a movie. What would happen though if the theater suddenly caught fire? 100 people would be frantically trying to escape. A few would want to enter the burning theater to attend the film. Michael Burry is concerned that the stock market will experience this. According to him, if the situation worsens, a lot of passive investors would attempt to exit the market and return to cash. But if everyone does this in a panic, stock values will plummet. What's more, when things go wrong, isolated enterprises frequently experience this. But what would happen if all of the passive investors, who as you well know own a small portion of everything, decide to quit at once? We suppose everything crashes then, right? The impact will be the same for all the index's stocks. The flip side of that coin is that even while there is a lot of trading activity going on in and out of these passive funds, there isn't actually a lot of trading going on in the underlying companies that make up the index. How is that possible? Undoubtedly, it's because the secondary market is where ETF share trading takes place the most. Also known as passive investors merely exchange investments with themselves. In a video by Ben Felix, he quotes two really interesting pieces of evidence regarding our topic today. The first comes from Vanguard and displays the proportion of ETF trading. It either happens in the secondary market or actually has an impact on the volume of trading of the underlying securities. They discovered that the secondary market was where trade took place 94% of the time. To put it another way, 94% of the total ETF trading activity didn't even touch the underlying stock positions that comprise the ETF. It happens though if there is high demand for an ETF, or perhaps a large volume of sales all at once. It's true that trading in the underlying stocks occurs when ETF units are created or destroyed in specific circumstances, but strangely, this is true even when you take into account the typical activity of creation and redemption. According to a BlackRock analysis from 2017, that still represents a very small portion of trade as a whole. In fact, they discussed a situation involving Apple, which at the time was the biggest business in the world. They pointed out that 650.9 billion shares of Apple stock were exchanged in July 2017, a month that saw significant inflows into ETFs. Even though 331 ETFs worldwide hold Apple, we discovered that at least 95% of the stock's trading volume in July 2017 was unrelated to ETF movements. So, despite the fact that ETFs have increasingly taken market share over the past 2 decades, they actually have a very small impact on the trading volumes of the underlying assets they hold. Burry may still have a point though, because Michael Burry, very plainly, believes that the stock market will collapse within the next 3 years. And if you believe that will occur, he may still be correct. When a stock market crisis occurs, there is panic. And when there is actual panic in the market, frantic selling cycles can occur. You are aware that a dip in stock prices might prompt a wave of irate sellers. Yet the increased selling volume brought on by the panic selling lowers the share prices even more. This may then trigger a negative feedback loop, which may swiftly lower the stock price. Burry therefore believes that there is a risk that the panic selling of market monitoring ETFs and resulting deconstruction of ETF units, if such a situation arises, could aggravate the decline in stock prices. The smaller, less traded equities that are still included in many of these major indices, in his opinion, are the stocks most at risk of duplicating this effect. According to him, the majority of the stocks in the Russell 2000 index in 2019 are lower volume, lower value traded stocks. We identified 1,049 stocks that we exchanged for less than $5 million today. That's more than half, and over half of those 456 equities only saw daily trading volume of less than 1 million. Nonetheless, hundreds of billions are connected to equities like this through indexation and passive investing. The S&P 500 is the same. Even though the index includes the largest stocks in the world, 266 of them traded today for less than $150 million. It may seem like a lot, but these stocks are indexed to trillions of dollars worth of assets worldwide. The exit door remains unchanged despite the theater becoming increasingly crowded. As global equity and bond markets become progressively less liquid, everything just gets worse. That's a pretty intriguing viewpoint, and it does make you question how these larger indexes' smaller cap stocks would perform if many passive investors leave the market during the next major crash. Normally, when a smaller firm is eventually included in the index, we applaud. In this case, it's possible that index inclusion isn't necessarily a victory. Well, that's about it for today's video. Let us know your thoughts in the comment section. If you found this video helpful, kindly click the like and subscribe button. Thank you for watching, and we'll see you in the next one. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!